2:17 a.m. You're not scrolling, you're doing math. Balance, due date, minimum payment. The average credit card rate at U.S. commercial banks was 20.97% in November 2025. So the balance can grow even when you stop. Morning comes and you open your bank app before the blinds. Not because you love money, because money is about to touch everything. Rent, gas, groceries, a car payment. Each one has a timer, and none of them care how old you are. Surveys find about 2/3 of Americans say they live paycheck to paycheck. Inflation isn't an econ lecture. It's the gap between your paycheck and the grocery receipt. The CPI was up 2.7% from a year earlier in December 2025. And the promise, study hard, get stable, has a crack. In 2025 Q3, 9.4% of student debt was 90-plus days delinquent. When payments slip, your credit score often feels it first. If personal finance feels impossible, it might not be you. It might be that you're using rules built for a world that quietly changed. I'm Dax, and if money feels hard, I don't think you're broken. I think you're using rules that were written for a calmer system. Cheaper housing, slower price changes, and borrowing that didn't keep running while you slept. Here are the early warning signs that the rules changed. 1. I'll just pay the minimum for now. With credit cards averaging 20.97% in November 2025, for now becomes a fee that grows in the background. 2. Your paycheck looks the same, but life gets slightly pricier. CPI inflation was 2.7% year over year in December 2025. 3. Housing feels like a locked door even if you're responsible. Freddie Mac's average 30-year fixed mortgage rate was 6.06% on January 15, 2026, meaning the cost of borrowing for a home is high before you even talk about the price of the home. And when 67% of Americans say they're living paycheck to paycheck, the stress isn't imaginary, it's structural. So no hype, just new rules, explained in plain English so you can breathe again. Here's the quiet mismatch. The rules you were taught are personal. But the rules affecting your bills are systemic. You were told, avoid dumb spending, make a budget, build credit, and you'll be okay. Meanwhile, the system is pricing money like it's scarce. In November 2025, the average credit card APR at commercial banks was 20.97%. And the federal funds rate, the baseline that influences everything from savings to loans, was about 3.72% in December 2025. So a small mistake doesn't stay small. A $600 car repair on a card can turn into months of rent paid to interest. Even when inflation cools, it still moves. The CPI rose 2.7% over the 12 months ending December 2025. Housing adds its own weight. The average 30-year fixed mortgage rate was 6.06% on January 15, 2026. And here's why it feels like you're running. Real hourly earnings were up 1.1% from December 2024 to December 2025. Better, but not magic. I'm Dax. Let's switch to rules that match the world you're actually in. Here's the rule you were never told. Personal finance isn't just your habits. It's also the weather. Habits are what you can practice. The weather is what you wake up inside. That's why two people can do the same responsible thing and get two different outcomes, depending on the year, the rates, and the job market. You didn't miss a secret class. The syllabus changed. When the price of money changes, time becomes expensive. Paying the minimum used to feel like getting by. At 20.97% average credit card interest in November 2025, it can become a treadmill that moves even when you stop. So in this video, we're switching from old rules to current rules. Not hustle rules, survival rules. We'll use 6 quiet indicators as our map: interest rates, inflation, housing prices, exchange rates, liquidity, and CDS, the market's insurance premium for default risk. Once you can read those, money stops feeling like a personal failure and starts looking like a system you can navigate. Think of interest rates as gravity. The higher they are, the heavier every loan feels. Student loans, car loans, credit cards. The Fed's effective rate was 3.72% in December 2025. It's not the rate you pay, but it sets the tone for what money costs everywhere else. Inflation is the slow fade of buying power. CPI was up 2.7% over the year in December 2025. Not a panic number, just enough to make almost enough turn into short, especially when rent is fixed and groceries aren't. Housing prices are the door cost. The Case-Shiller National Index was around 328 in October 2025. And the key, mortgage rates, averaged 6.06% on January 15, 2026. High prices plus high rates is how a normal salary feels locked out. Exchange rates are the outside world's vote on a currency. The real broad dollar index was 114.8 in December 2025. When that vote shifts, imported stuff shifts. Fuel, phones, even car parts. A small move in any one of these can quietly rewrite your whole month. A financial shock is when normal life hits a wall. Layoffs, a bank wobble, a sudden spike in rates, a currency drop. The scary part isn't a headline, it's the chain reaction. Most chain reactions start with liquidity. Liquidity is simply, can you get cash when you need it, without taking a huge loss? In a liquidity crisis, demand for cash jumps while the supply of easy cash dries up across many institutions. Picture a crowded room and one narrow exit. Nobody panics until they think somebody else might. Then people move faster and the exit gets smaller. In real life, that looks like lenders tighten, credit limits shrink, employers delay hiring, and even good borrowers get treated like risks. That's why shocks feel personal. You didn't suddenly become irresponsible. The room changed, and the rules for getting help got tighter. And when liquidity tightens, your backup plan becomes expensive, fast. The same $400 emergency can turn into months of interest and stress. Now, CDS. Credit default swaps sound like Wall Street noise, but they're a useful mood thermometer. A CDS is a contract that lets someone buy protection against a borrower defaulting, like insurance on a bond. The buyer pays a fee, often quoted in basis points. If a credit event happens, the protection can pay out. Reuters explains CDS as a way investors insure against default and watch credit stress in real time. When CDS prices jump, it's the market saying repayment feels less certain, even before a company or country actually misses a payment. Here's the personal translation. Your credit score is your CDS spread. When your score drops, your borrowing costs rise. Same idea, smaller scale. So we're not learning CDS to trade them. We're learning them because fear leaves fingerprints in prices, and fingerprints show up early. Once you can spot them, you can choose calmer, safer moves. That's the point. Early warnings without panic. So you can protect yourself before the room starts rushing the exit. Let's rewind to 1997. Several Asian economies looked strong until their currencies cracked. A currency peg is a promise. Our money will stay worth this much. That promise can feel like stability. It can also invite risk. One common pattern. Businesses and banks borrowed short-term in US dollars, then earned in local currency. It worked, until investors got nervous and tried to pull dollars out. Suddenly, the exchange rate moved. Local currencies dropped, dollar debts got bigger overnight, and lenders stopped rolling loans. That's liquidity leaving the building. The IMF describes how, in late 1997 and early 1998, it provided $36 billion to support reform programs in Indonesia, Korea, and Thailand, within international packages totaling almost $100 billion. Notice what broke first. Not effort, not character. The rule that broke was, my currency will hold. When that rule fails, everything priced in dollars reprices a country in real time. That's why exchange rates belong in your personal finance toolbox, even if you never trade currency. Here's why 1997 matters to you in 2026. The core mechanism is simple. When money is cheap and confidence is high, the system forgives mistakes. When confidence drops, the system charges you for time. In the Asian crisis, some countries raised interest rates to defend their currencies, but higher rates also squeeze businesses and jobs. Families didn't wake up lazier, the math changed. This is the wrong rule trap. You keep using personal discipline to solve a problem created by prices and credit. That can make you feel guilty for something you didn't design. So the goal isn't to predict every crisis. The goal is to build a life that doesn't collapse when one knob gets turned. Because even in the US, when credit tightens, internships vanish, hours get cut, and the adult life timeline shifts. Stability isn't just income. It's resilience to a system that sometimes stops lending patience and starts charging for uncertainty. In personal finance terms, your emergency fund and low fixed costs are your liquidity line, your way of not being forced to borrow at the worst moment. Argentina is a lesson in what happens when inflation and trust start feeding each other. When people expect prices to rise, they rush to spend, convert currency, or demand higher wages. That pressure can push prices even higher. Then the exchange rate becomes a daily drama instead of a background number. In 2018, the IMF approved what it calls the largest standby arrangement in its history for Argentina. After an increase, access reached about $57 billion. On paper, that's macroeconomics. On the street, it's smaller. Your paycheck buys less each month, and saving in the local currency feels like holding ice. Young people don't stop caring about the future. They stop trusting the measuring tape. They start making shorter plans, not because they're shallow, because the numbers won't sit still. That's why budget harder isn't always the right rule. Sometimes the rule is protect buying power, protect options, and don't build your whole plan on a currency you can't trust. Greece is a different kind of lesson. A country can be trapped even without runaway inflation. Greece used the euro. That meant stable currency, but also less control. When debt and deficits collided with a global crisis, markets demanded higher yields, and Greece couldn't simply print its way out. The IMF documents Greece's 2010 standby arrangement and the reality of emergency financing when markets won't lend at normal rates. It also notes Greece became the first euro area country to request IMF support in 2010. For ordinary people, the crisis wasn't a spreadsheet. It was unemployment, pay cuts, and a feeling that the rules changed, but my paycheck didn't get the memo. And this is where CDS shows up again. When investors doubt repayment, borrowing costs rise. Your life can be stable, and the price still climbs. So if you've ever felt judged for being behind, remember, whole countries can be behind when financing stops. That's not a personality flaw. It's credit. Turkey shows how a currency can wobble while everyday life keeps moving. Until it can't. High inflation and high interest rates can exist together when trust is fragile. Reuters reported Turkey's inflation around 31% and policy rates around 38% in early January 2026. That combination squeezes borrowers, slows hiring, and makes basic planning feel noisy. An IMF review warned about high external financing needs and vulnerability to shifts in sentiment. Basically, a system that can be knocked off balance by confidence. When the currency weakens, imported things get pricier: fuel, medicine, electronics. When rates rise, loans become heavier. So young adults feel it twice, at the store and at the bank. If this kind of calm, no-hype explanation helps you breathe, you can subscribe to DAX Invests. This is exactly what we do here. And now, the most extreme example of the same knobs: Venezuela, where exchange rates and inflation stopped being signals and became the whole story. Venezuela is what happens when inflation, fiscal stress, and exchange controls turn into a long collapse. IMF research describes Venezuela's economic collapse and historic humanitarian crisis, shaped by large deficits and very high, long-lasting inflation. In that environment, an official exchange rate can become a fiction, while the street rate becomes the real price of life. This is not a story to scare you. It's a story to show the endpoint of the wrong rules. If money loses its job as a measuring tool, planning becomes almost impossible. People don't become irrational, they adapt. They hold harder currencies, they barter, they leave, or they work multiple jobs just to keep the lights on. That's the takeaway. Stability isn't just income. It's a system where prices, rates, and currency stay readable. Now let's come back to the US, because the US is not Venezuela. But the same indicators still matter, and ignoring them is how young adults get blindsided when the cycle turns. In America, the crisis usually arrives quietly, not as hyperinflation, but as, why is everything harder than the math I was taught? Start with housing. The Case-Shiller National Index sits around 328, October 2025, which is another way of saying prices stayed high. Then add the cost of borrowing, 6.06% average mortgage rates in mid-January 2026. Even if prices rise slowly, high rates can keep the door shut. So the rent versus ownership debate isn't just preference, it's interest rates plus home prices plus timing. Now add the cost of short-term survival. Credit cards around 20.97% in November 2025. That's why a single emergency can turn into a long season. And when the Fed funds rate moves, 3.72% in December 2025, savings yields and loan rates tend to follow. The new rule is, your budget isn't a moral document, it's a risk plan. It's a way to stay liquid when the system tightens. That's why so many people feel stuck, not from laziness, but from math. So what do governments and central banks actually do when things break? Government usually moves with budgets, unemployment support, disaster aid, stimulus checks, infrastructure spending. That's fiscal policy, money sent through the law. The Federal Reserve moves through the plumbing. The Fed's core tools include open market operations, the discount rate, and reserve requirements. In plain terms, it can add or remove money-like liquidity, and it can change the price banks pay to borrow. In a panic, the Fed acts as a lender of last resort, making short-term loans through the discount window when private liquidity dries up. And it has emergency authority under Section 13(3) in severe stress. None of this is about making you rich. It's about keeping the system from freezing. When the plumbing works, your paycheck clears, your card payment posts, your employer can make payroll. When it doesn't, normal life becomes a crisis. Fast. Sometimes the Fed doesn't just change short-term rates. It changes its balance sheet. Quantitative easing, QE, is when the Fed buys longer-term securities to push down long-term yields, support liquidity, and ease financial conditions. It's not free money. It's a way to lower borrowing costs across the economy when the usual rate tool isn't enough. Even outside classic QE, the Fed may buy short-dated treasuries for reserve management to keep liquidity ample and maintain control of rates. Here's why you should care. Long-term yields influence mortgage rates, business loans, and job growth. When liquidity is tight, the economy feels brittle. When it's ample, the economy can absorb shocks. This is the deeper rule. Your personal plan works best when you understand the system cycle. Tight, then loose, then tight again. And that leads to the practical part. How a 19-year-old builds stability without pretending they control the Fed. That's a system-level reason your personal rates can change without you doing anything wrong. Let's translate macro into everyday survival. Rule 1. Build a small buffer before you build a big dream. Even $300 to $1,000 can change how a surprise feels. Liquidity at home is a cash cushion, enough to turn a crisis into an inconvenience. Rule 2. Respect interest like you respect gravity. Credit cards near 21% are not neutral. Auto loans were around 7.5% for 72-month new car loans in November 2025. Rates tell you which debts are urgent and which can be paced. Rule 3. Don't let one bill control your whole month. A car payment, rent, or student loan is a fixed rhythm. And student loans are not a niche issue. 9.4% of student debt was 90-plus days delinquent in 2025 Q3. Rule 4. Protect your credit score like it's your rent deposit. It's not status, it's future pricing. Rule 5. Choose flexibility over image. Roommates, older cars, boring meals, these aren't failures. They're shock absorbers that buy you time. And when you can, automate the boring stuff. Late fees are the most avoidable kind of expensive. If you take one thing from this, let it be this. Money gets easier when you stop using the wrong rules. Old rules say, work harder, budget harder, blame yourself when it still hurts. New rules say, watch the knobs. When rates rise, protect cash flow. When inflation cools, don't exhale too early. When housing stays high, don't build your identity around ownership. Look at exchange rates, and you're seeing global confidence. Look at liquidity, and you're seeing whether the system can breathe. Look at CDS, and you're seeing where fear is pricing default risk. I'm Dax. I can't promise a shortcut, but I can promise clarity. Control isn't getting rich fast. Control is being able to pay rent, handle a surprise, and make one decision at a time without panic. And that's the quiet win. Not becoming a different person, just using rules that match the world you're in. Because if the world keeps changing, the most powerful skill isn't speed, it's steadiness. You still get to want more. You just don't have to gamble your safety to get there.